Since the chief emphasis is placed on avoidance of loss, bond selection is primarily a negative art. It is a process of exclusion and rejection rather than of search and acceptance. Before starting this video, I would like to thank my friends who had gifted me this mic, which I have hopefully set up correctly. Hi guys, it's me Vedant, and in this video I'm going to be discussing a very fascinating approach to investing which is extremely relevant in today's information age that we live in. This introduces us to a very interesting mental model or a framework of thinking which applies not just to stocks but also to many different aspects of life. Let's dig deeper. With over 5,000 stocks trading on the exchange, clearly there are many more ways of losing money than making. Therefore, as mentioned in the quote earlier, chief emphasis should be placed on avoiding losses. Also, it is not practically possible for an individual to go through 5,000 companies. Therefore, we must have filters to make sure we focus on few and avoid most of the companies. We observe this mental model apply in many different aspects of life as well. Let me share a few. This also applies in screening tests or entrance exams. These exams are designed to eliminate most of the candidates so they can select only few. Oftentimes, in improving a person's health, avoiding and excluding junk food often plays a much more significant role than exercising itself. Also, while making friends or building different relationships, people define red flags for themselves. They are basically indicators which will help them avoid certain people. You guys must have been seeing a theme emerging right now. Well, this model tends to work very well when there are a large pool of options, but we have to filter and finally arrive at only a few. Another famous investing firm called Oaktree described their motto as avoid the losers and the winners take care of themselves. Let's define some parameters for defining a loser. Well, if a company is distressed in debt or it is loss making, the company has a history of scams or malpractices. Well, these filters themselves happen to eliminate a large universe of stocks, so we can focus on the important ones. On that note, let me discuss 5 biggest mistakes that investors have to avoid when investing in the stock market, 2 of which I struggle with even today. Let's start from 5. Having unrealistic expectations. Public often start investing after hearing their family and friends make large amounts of money from the stock market in a short span of time. This builds up expectations. Apart from that, brokerages also advertise investing in a form such that it builds up expectations for first timers. Let's go back to basics once. Well, a stock is a piece of a company, and for the stock to perform well, the underlying asset, which is the company, has to do well. And for a company to do meaningfully well, it takes time. But because we have got the option of buying and selling stocks at our fingertips, this option or this privilege is often abused. Humans are not creatures of logic and rationale. Well, we react and often respond disproportionately to news, which makes us take rash decisions such as buying and selling stocks out of fear and panic or euphoria. In reality, stocks should be treated like any other investment asset. For example, like real estate. When a person buys a rental property or a piece of land, they never buy it with the intention of selling it within 3 months, 6 months or so. They keep it for a few years at least. An investor in general should expect about 12 to 13% annual compounded returns from the market. This is what has been happening for the previous decades and can be expected. Now let's come to number 4. Well, this one is mixing trading and investing. A trader is generally expected to have a good idea of how long the trade is going to last, the stop loss, and also the exit price or the price at which he's going to sell. Stop loss is meant by the maximum loss that will be tolerated during the trade. When trading, people generally ignore the core business of a company and actually focus more on the news or the patterns that the stock price is making, which is useful in predicting short-term movements. So sometimes people take up a trade and they realize that they are going to make a loss, and reluctant to actually exit the position and take the loss, they end up becoming a long-term investor in what they thought would initially have been a trade. This makes their money, which they could have used for trading, get stuck in a bad company and make it a poor investment. While we are on the topic of trading, let me share an interesting statistic that was given by Nitin Kamath, the CEO of Zerodha, the biggest discount broker in India. He said that less than 1% of retail traders actually make returns that beat fixed deposits. Well, this means that even lesser actually beat the market returns. So this gives you a perspective on how many people really make money from trading. Now let's come to number 3, which is poor diversification. Well, investing in individual stocks demands us to understand the company exhaustively, such as the management, the business model, the industry it operates in, and etc. This is necessary so we can actually understand the risk that we are getting into. The problem of diversification is solved very efficiently through mutual funds and index funds, such as that of Nifty. In case you're not aware of these, I've made a video on them and I'll link it in the description below. It is generally advisable to make a portfolio using at least 20 to 30 stocks, so that even if your biggest holding in the portfolio goes to zero, your portfolio as a whole does well. Now let's come to number 2, which is tracking markets frequently, which is something even I get annoyed by myself. This is a bad habit if you're interested in long-term investing, because that requires you to analyze a company and its business in depth. And we need to make sure we ignore the noise. But the stock markets and the price movements are often full of noise, and they can distract us and give us an urge to act. This makes people unnecessarily adjust their portfolio and get affected by the noise. Lastly, let's come to number 1, which is the worst habit of all, which is of taking stock tips. Before I explain the exact problem with stock tips, we need to first take a step back, and which is we must remember that investing and compounding are almost synonymous. And for compounding to really work its magic and for us to reap its benefits, we need to sit for a long period of time. And for actually staying invested in a stock for a long period of time, what we must have is conviction. We must actually convince ourselves that this company is actually really good and it will continue doing well even a few years down the line. And this conviction is cultivated or developed only after you have done the research and satisfied yourself with the company. And therefore, when we take stock tips and invest blindly based on them, what ends up happening is when we take a small loss, we end up selling it because we actually didn't understand it anyways. And if we even make a small profit, we quickly exit it because we are happy because we made something. And another problem is that we are constantly bombarded by lots of stock tips through brokerages, from family, friends, and so on. And therefore, we must be extremely cautious while taking them. We need to make sure that we do our research when we actually hear about a company first. So next time when you're spoiled for choice, well, you can start off by first eliminating them. That's it for this video, guys. Make sure to smash the like button and subscribe if you haven't already.